So, if you were just reading the headlines on April 14th, 2026, you'd probably assume an Iranian port blockade would mean, a massive market crash. Right?
Oh, absolutely. I mean, the initial reaction was just pure panic.
Right. But if you look at the actual data, it's crazy. Welcome to today's deep dive, by the way. Our mission today is to unpack how a single Chinese tanker in the Strait of Hormuz and a dovish pivot in Japan triggered this massive $543 million crypto liquidation event.
Yeah, in just 24 hours.
Exactly. And it actually engineered a sudden 5.22% structural breakout in Bitcoin. So let's trace these mechanics because it's a wild ride.
It really is. I mean, at first things totally froze up. Traders were just terrified of this inflation spiking oil shock coming out of the Middle East.
Which makes sense, logically.
Sure. When the U.S. actually initiated that blockade of the Iranian ports, the crypto fear and greed index plummeted. I mean, it hit a crushing 12.
Wow, 12. That's bleak.
Yeah, it's capitulation territory. But that fear didn't actually last because verifiable maritime data just completely flipped the algorithmic script.
Right, the tanker. So there was this sanctioned Chinese tanker, the Rich Starry, and it basically just sailed right past the U.S. destroyers.
Yeah, just bypassed them entirely.
Simply by broadcasting China owners and crew on its transponder. It's almost like a VIP nightclub bouncer enforcing this really specific porous guest list.
That's a great way to put it, actually. And that single transponder ping acted like a huge pressure release valve for the market. Plus, relief compounded when Iran shifted away from a 20-year nuclear standoff.
Oh, right. They offered that quantifiable 5-year moratorium counterproposal.
Exactly. And the mechanism here is what's crucial. This geopolitical shielding essentially mathematically proved that commercial energy logistics were going to survive.
So it neutralized the immediate threat of, triple-digit oil prices.
Yes. And more importantly, it killed the fear of sudden, crippling inflation constraints.
Okay, so if Middle Eastern oil isn't going to spike global inflation, that takes a ton of pressure off central banks.
Yeah.
How did Japan react to this sudden breathing room?
Well, it gave the Bank of Japan the exact rhetorical cover they needed to hold steady. BOJ Governor Ueda cited the Middle East volatility to justify pausing a really highly anticipated interest rate hike.
Wait, the April 28th hike?
Yeah, that one.
Right.
The market probability of that April 28th hike crashed from 60% down to just 33%, basically overnight.
Okay, I'm stuck on something here. If the Middle East is volatile, shouldn't markets be pulling back across the board?
You would think so, yeah.
Right, so how does dodging an oil crisis actually rescue a massive liquidity trade in Japan? I mean, the yen carry trade is essentially just borrowing cheap money in Japan to buy higher returning assets elsewhere. So how does this twist a macro risk into a huge liquidity green light?
That's the million-dollar question. Because global inflation fears dropped, the BOJ could justify maintaining their negative real interest rates, which, by the way, are currently sitting at negative 2.15%. Right, and that preserves the extremely cheap fiat funding that these quantitative algorithms desperately need to bid up high beta assets.
Ah, I see. So the moment Japan kept the money spigot open, all that trapped capital rushed straight into the open liquidity valves.
Exactly, and it directly hit the crypto markets. This sudden guarantee of cheap global liquidity acted like a match dropped into a really heavily over-leveraged derivatives market.
Which pushed Bitcoin from that $70,534 floor to nearly $75,000?
Yeah, the fallout was entirely mechanical. We saw $543 million in algorithmic margin closures.
Including that massive one on Hyperliquid, right? Like $9.85 million in a single liquidation.
Yes, exactly. But what really stands out to me here is the behavioral divergence. The big players reacted so differently to this squeeze.
Yeah, it's wild. On one side, you have macro hedge funds, like Brevin Howard, slashing their holdings by 85%.
Right, and reactionary retail traders totally panicked. They triggered $291 million in spot ETF outflows.
But then on the other side, you had registered investment advisors, the RIAs, just quietly absorbing all that supply. Why are fiduciary advisors buying the dip when all the fast money is just fleeing in panic?
Because it's programmatic rebalancing. Retail reacts to headlines, right, but RIAs operate on very strict model portfolios.
Oh, so if Bitcoin drops below its target allocation, their algorithms just automatically buy to rebalance.
Exactly. And the infrastructure supporting those fiduciaries is expanding so fast right now. Look at Broadridge. They just deployed a unified Canadian platform allowing wealth managers to seamlessly integrate digital assets right alongside traditional equities.
So for anyone listening and adjusting their own analytical models right now, The takeaway is pretty stark. Bitcoin's structural floor isn't really dictated by fast money speculators anymore.
Not at all.
That retail panic was effortlessly absorbed by the sticky, programmatic rebalancing of fiduciary capital.
It completely shifts the entire market dynamic, which actually brings up a much deeper issue.
Yeah, I mean, you have legacy institutions like Broadridge building these infrastructural pipes, while simultaneously the U.S. DOJ is launching a data-driven National Fraud Enforcement Division.
Right, to algorithmically police the market.
Exactly. So here's something for you to mull over as you build your next model. What happens when Bitcoin's price discovery becomes entirely dictated by corporate mainframes rather than decentralized human actors? If the global market is a machine, the algorithms aren't just reading the data anymore, they're writing the outcomes in real time.